72 hours ago, while global markets were quiet and most of the world was focused on interest rate rumors and political noise, a switch was flipped inside China, Deng's financial system, that permanently changes how global money will move from now on. There was no announcement, no emergency broadcast, no press release. But at exactly the moment Western trading desks were empty, Beijing authorized the largest coordinated capital restructuring ever executed by a single country. Nearly $4 trillion repositioned in silence, not transferred in one transaction, not sent through visible market orders, but rerouted through dozens of financial corridors that most investors never even look at. Clearing systems, sovereign funds, state banks, commodity settlement platforms, all moving in alignment. And by the time American markets opened, the structure of global liquidity had already shifted. This was not about profit. This was about control. Because China did not simply sell U.S. assets and buy new ones. They rewired where their national wealth is anchored, away from paper promises, away from foreign debt, and into assets and systems that cannot be frozen, sanctioned, or manipulated by Western financial institutions. For years, analysts kept asking why China was reducing treasury exposure even when yields were rising, why they were expanding gold imports through indirect channels, why they were building alternative payment systems instead of relying on SWIFT. The answer is now obvious. They were preparing the ground before making the move, and the move just happened. Multiple sources inside Asian banking networks confirmed a synchronized activation of reserve conversion programs across Chinese state-controlled financial entities. Reserves that were previously sitting in dollar instruments were converted into physical commodities, strategic metals, energy contracts, and bilateral currency settlement positions that bypass the dollar entirely. This isn't speculation. You can already see the effects in shipping insurance markets and commodity delivery premiums and overnight swap pricing between Asian and Middle Eastern banks. Liquidity is being redirected into a parallel system that does not depend on New York or London to function. And here's why this is dangerous for the current global order. The dollar doesn't dominate because it is strong. It dominates because everyone is forced to use it. Energy is priced in it. Trade is cleared in it. Debt is settled in it. That forces foreign nations to hold U.S. assets, whether they trust the system or not. But China just removed that requirement for itself and for its trading partners. And once that door is open, it never closes again. This explains the sudden rise in commodity stockpiling across Asia. It explains why certain export nations are now accepting non-dollar contracts for oil, gas, and industrial materials. It explains why U.S. bond markets are becoming more sensitive to relatively small shifts in foreign participation. Because when reserve recycling slows, the debt machine starts to strain. The United States funds its entire government by selling debt that foreigners must absorb. When that demand weakens, the Federal Reserve becomes the buyer of last resort. And that means more money creation, which means weaker currency, which means faster loss of confidence, which means even more capital searching for alternatives. This is how monetary transitions actually happen. Quietly at first, then suddenly all at once. And China understands this better than anyone because they have spent decades studying how previous reserve currencies collapsed. The British pound, the Dutch guilder, even ancient empires that lost trade dominance after financial overreach. The pattern is always the same. Debt expands faster than productive capacity. Confidence erodes. Alternatives emerge. Capital migrates. China didn't cause this weakness. They simply positioned themselves to benefit from it. And now they are accelerating the timeline. Because when reserve holders start converting en masse, markets don't adjust gradually. They snap. What makes this move especially dangerous is that it wasn't emotional or reactive. It was mechanical, formula-driven, executed through pre-built infrastructure that was designed years in advance. That tells you this wasn't a panic response. It was the final step of a long-term strategy. Which means Beijing already expects the next phase to be turbulent, and they want to be insulated when it begins. The immediate effect will not be visible on stock charts. It will show up in funding markets, in cross-border settlement delays, in rising collateral requirements, in sudden credit tightening that seems to have no obvious cause. Banks will become cautious, lending will slow, risk models will be adjusted, and once that happens, asset prices that depend on cheap money start losing support. At the same time, physical asset demand will rise, not from retail investors, but from institutions that suddenly realize paper contracts are no longer reliable in a fragmented financial world. This is why metal inventories are draining, why energy storage is expanding, why strategic reserves are quietly being rebuilt across Asia and the Middle East. Everyone who understands what is happening is preparing for financial fragmentation. And fragmentation always favors countries that control physical supply chains, which is exactly what China has spent 20 years building. Manufacturing, logistics, refining, rare earths, battery metals, shipping infrastructure, all integrated into a system that can operate even if Western finance becomes unstable. This is not accidental. This is economic warfare without missiles. And the reason it's effective is because debt-based empires collapse from inside, not from invasion. You don't need to attack the dollar, you just need to stop depending on it. And China just proved they can operate at scale without it. $4 trillion is not symbolic, it is decisive. It tells every other nation that the exit door is functional. And once exit doors appear, capital starts moving whether governments approve or not. That's when things accelerate, because markets are not patriotic, they are mathematical. And math, have you ever wondered how a global superpower falls? It doesn't happen with a bang, but with a quiet, almost invisible shift in the flow of money. And right now, we're living through one of the most significant financial shifts in modern history. It started subtly. Western banks started noticing minor, almost boring delays in settlements from Asian clearinghouses. Currency swaps that for decades cleared through New York were suddenly being rerouted. They were now passing through bilateral agreements in Shanghai, Hong Kong, and the Gulf. To the average person, this sounds like technical jargon, but for the giants of finance, for the institutions that live and breathe by the speed of liquidity, this was a massive red flare shooting up into the sky. Because when money stops flowing through the old, familiar pipes, it means only one thing. Someone, somewhere, is building new ones. And the first to notice weren't bankers in London or New York. It was the major commodity exporters, the lifeblood of the global economy. Oil producers in the Middle East, copper suppliers in South America, lithium processors, and agricultural giants. They were all quietly approached with a new kind of deal. Contracts that completely eliminated their exposure to the US dollar. Think about that for a second. Payment in Chinese yuan. Settlements in special clearing accounts linked to the value of gold. Financing backed not by Western lenders, but by Chinese banks. For countries that have spent decades living under the constant threat of sanctions and financial coercion from the West, this wasn't just an attractive offer. It was liberation. It was a chance to break free. And here's how these things gain momentum. Once a few major players accepted these new terms, the rest faced a stark choice. Trade networks, by their very nature, rely on standardization. If all your neighbors suddenly stop pricing their goods in dollars, you either adapt or you risk being cut off from vital markets. This is the real way reserve currencies change. It's not announced in grand speeches at international summits. It's decided in the fine print of contract clauses, one shipment at a time. And as this was happening, inside the marble halls of US financial institutions, alarm bells were screaming. But there was a terrifying realization. There is no clean counter-strategy. How do you force the world to hold your debt when a viable, alternative settlement system already exists and is growing by the day? The power of sanctions evaporates when your targets no longer need your banks to clear their transactions. The power of interest rate policy weakens when foreign nations are no longer buying your government bonds to finance your deficits. And those deficits, they are the heart of the problem. The United States government is now in a position where it must issue trillions of dollars in new debt every single year. Not for new projects, but just to pay off its old obligations. It's like using one credit card to pay off another. This entire system only functions as long as foreign capital, those trade surpluses from other countries, keeps getting recycled back into US Treasury bonds. But what happens when that recycling slows down? When countries start sending their money elsewhere? The Federal Reserve, the US-owned central bank, is forced to step in and buy that debt itself. And when the Fed steps in, it does so by creating new money out of thin air. This is currency dilution. And the more it happens, the less valuable the dollar becomes, which in turn pushes even more capital away from the dollar. This isn't a political theory. It's cold, hard arithmetic. It's a feedback loop, a financial death spiral. And China just found the exact pressure point to accelerate it. Bond traders, the ones on the front lines, are already seeing very strange behavior in the markets. Sudden, unexplained bouts of volatility, gaps in liquidity where it should be plentiful, weak demand at government bond auctions that is then mysteriously absorbed by quiet, behind-the-scenes central bank purchases. Publicly, the message is always, everything is fine. But privately, on the balance sheets of the world's largest financial institutions, risk is piling up. And when banks feel that kind of pressure, what's their first move? They tighten credit. They stop lending as freely. And when credit tightens, the asset bubbles that have been inflated by years of easy money begin to deflate. Stocks, real estate, you name it. And when those bubbles pop, how do governments typically respond? With stimulus, which means more government spending, which means more debt, which means more money creation, which leads to an even faster loss of confidence in the currency. This is the feedback loop that has ended every reserve currency era in history. But there's a massive twist to this story that most people are completely missing. This historic financial transition isn't happening in a vacuum. It is happening at the precise moment that industrial demand for physical resources is absolutely exploding. We're talking about the raw materials that will build our future. The copper, lithium, and nickel for the electric vehicle revolution. The vast energy resources needed to power AI data centers and expand our electrical grids. the steel and aluminum for military rearmament happening across the globe. All of it requires massive, unprecedented quantities of physical metals and energy. And who sits at the absolute center of most of the world is refining and processing pipelines for these critical materials? China. This means they control the choke points, not of the financial economy, but of the real physical economy. So while Western markets are trapped in a world of financial abstractions, derivatives, and digital assets, China is methodically positioning itself as the indispensable anchor of real, tangible supply. And in this new world, that makes financial leverage far less relevant. You cannot financially short a factory that has a monopoly on output. You cannot manipulate shipping routes that now operate under new insurance networks outside of your control. And you certainly cannot pressure trade partners who no longer depend on your currency for their economic survival. This is why the mainstream financial media keeps missing the plot. They're watching the stock market ticker. But China is changing the world's infrastructure. And changes to infrastructure are slow, they are nearly invisible to the public, but once they are built, they are practically unstoppable. So, what happens next? It's probably not the sudden, dramatic crash that many people envision. It's something more complex and perhaps more disruptive. Fragmentation. We are heading towards a world where different regions operate under completely different financial rules. A multipolar world with different reserve currencies, different settlement systems, and different spheres of economic influence. This fragmentation will destroy the hyper-efficiency that the age of globalization was built on. And the result of that? Higher costs for everything. Persistent inflation that no longer responds to the old tool of raising interest rates. A world where the trusted policy tools of central bankers simply stop working. That is the environment where currency regimes finally break. And Beijing knows this. They are not playing for a good trading quarter. They are playing to dominate the next monetary era. This monumental shift we are seeing wasn't designed to shock the markets overnight. It was designed to make any potential Western response completely obsolete before they even realized what was happening. The real danger facing us right now isn't about what China is doing. It's about what Western governments are about to do in response. Think about it. Whenever a system built on debt sees demand from the outside world dry up, it always turns inward. It has to. So governments start taxing more, regulating more, and watching every transaction like a hawk. They tighten financial controls, all under the banner of keeping things stable. And this isn't some future prediction. It's happening right now. We're seeing the infrastructure for digital currencies being built out. We're hearing about tracking transactions and new emergency powers for banks. These are all sold to us as tools to protect financial stability. But in reality, they're tools for governments to keep control over a monetary system that's shrinking. If they can stop capital from leaving, it becomes much easier, politically, to devalue the currency. This is the classic playbook for how governments buy themselves time when public confidence starts to fade. The problem is, buying time doesn't fix the underlying structural issues. It just postpones the day of reckoning. Meanwhile, the smart money, the private capital, is already making its move. Big investment funds are quietly reducing their exposure to government bonds. Commodity producers are locking in long-term deals that don't even involve the dollar. Major multinational corporations are diversifying their cash holdings, moving away from U.S. debt. They're not doing this because they have some agenda against America. They're doing it because they understand risk. And right now, the monetary risk is climbing much faster in economies drowning in debt than it is in economies backed by real, tangible assets. This is why you're seeing a rise in what's called physical resource nationalism. Countries are scrambling to secure their own supply chains instead of just trusting the global markets. We're hearing more about industrial policy and less about free trade. The world is quietly preparing for a major financial storm, even while politicians are on TV telling us everything is perfectly normal. And China just sent a signal that they expect this storm to hit sooner rather than later. Their massive $4 trillion shift in assets wasn't subtle. It was a clear message. We no longer trust the stability of the current financial system. And when a country that holds that many reserves starts losing trust, the clock officially starts ticking. From this moment on, every single crisis will speed up this transition. Every banking scare, every political drama over the debt ceiling, every geopolitical conflict that threatens our trade routes, each one will push more and more capital into alternative systems. And as more people defect, those alternative systems get stronger and stronger. This is how financial gravity shifts. It doesn't happen overnight in a big, dramatic crash. It happens relentlessly, day by day. For the average person, the effects will be subtle at first. You'll notice prices at the grocery store creeping up. It might get a little harder to get a loan. Your savings account will feel like it's losing purchasing power, even if the interest rates go up a bit. But over time, the gap between financial assets like stocks and real-world goods will get wider and wider. The stock market might even surge while the currency gets weaker. And the cost of basic necessities, food, gas, housing, will become more and more expensive compared to what you earn. This is how wealth transfers happen during these big monetary transitions. It's not just through market crashes. It's through a silent, slow erosion of value. Those who hold assets that can't be printed, like real estate or commodities, tend to maintain their wealth. But those who rely on paper claims, like cash in the bank or government bonds, slowly fall behind. History shows us this same cycle over and over again. Great empires rarely fall because of a foreign invasion. They fall because of financial exhaustion. China isn't launching a military attack. They're just letting the simple, cold, hard math do the work for them. And math always wins in the end. Now, the final piece of this puzzle is psychology. Because once people lose faith in their money, their behavior changes incredibly fast. People rush to spend their money before it loses more value. The savings rate plummets. Speculation goes through the roof, and volatility becomes the new normal in the markets. And that is the point when governments intervene much more aggressively. They'll introduce price controls, restrictions on moving your money, and use their emergency powers. All of this will be framed as necessary to protect you. But in reality, these are just panicked reactions to a system that is fundamentally broken. And once those controls are in place, public confidence erodes even faster. It becomes a frantic race between capital trying to escape and regulators trying to trap it. China already ran this race internally. They got their money out before the restrictions could trap their reserves inside weakening systems. They made their exit quietly while the doors were still open. And now they're essentially offering an exit ramp to other countries. That's what makes this moment so historic. It's not about the daily market headlines. It's about the fundamental realignment of the global financial infrastructure. Power is shifting away from a system based on paper and debt toward one based on real physical assets. And that shift is accelerating. That $4 trillion move wasn't the beginning of this story. It was the confirmation that the transition phase is over. We are now in the execution phase. From this point forward, the system will not be returning to the old normal. It's going to adapt into something new, something more fragmented, less efficient, more volatile, and far more political. For decades, markets operated under the grand illusion that money was neutral and that it was infinite. That illusion is now breaking, and when it breaks, societies are forced to confront their limits. The limits of debt, the limits of consumption, and the limits of government control. China has already accepted these limits and has structured its entire economy accordingly. The West has not. And that is precisely why the adjustment is going to be far more painful in the places where debt is the highest and production is the weakest. The future won't belong to the countries with the most clever financial engineers. It will belong to the countries with the strongest and most resilient supply chains. And that new reality is reshaping global strategy much faster than most people realized. That $4 trillion shift wasn't just a trade. It was a declaration of independence from a system that no longer serves their interests. And once these movements for financial independence succeed, political influence always follows. That is the long game that's being played right now, quietly, relentlessly, and almost completely unnoticed by the public. At least until the consequences show up at the grocery store, the gas station, and in your mortgage payment. But by then, the smart capital will have already moved, the new systems will have already been built, and the opportunity to reposition yourself quietly will be long gone. History never announces its major turning points. It only reveals them in the rearview mirror long after they've passed. And it looks like one of those turning points just happened while most of the world was looking the other way. Thanks for watching. If you found this valuable, please like and subscribe for more insights.